I'm joined by Christopher Ailman, CIO of CalSTRs. Nice to see you again at the Milken Global Conference.
Good to be here. Thank you for the time.
You currently manage $191 billion, which is hard to wrap your head around. What does a guy that manages that kind of money think about in terms of the Fed eventually making a move on interest rates? How do you approach the way you view your own investments?
We have a couple of different house views. One of them is on changes in the Federal Reserve and the disruptions. Because for the first time you've got the US Fed and maybe the Bank of England tightening. And yet you've got the ECB and the Bank of Japan easing. So you've got a change in that, and that dynamic has impacts not only in the credit markets but to us in the equity markets. So we're going to be paying attention to our Fed, but not just our Federal Reserve, all the central banks. We're not as hung up, if they raise rates from 0 to a quarter, come on, it's a quarter. It's not that material. Yes, it signals a change in direction, and that'll have an impact, but we think that overall the markets are still going to be stimulative, and that we could be keep investing in equities for at least another year and be in good shape.
And of course you have a long-term horizon. So generally speaking, are you more invested in equities on an asset allocation base than fixed income than you've been in the past?
Not a little bit more than in the past. You're right on the spot. We're very long-term. We have a 30-year investment horizon. We cover all the public school teachers in California, so 800,000 people, and they have a very long life. And so for us, we've always had about 70 to 80% in equities. Right now, we're probably about 85%. When I say equities, I'm going to put real estate, private equity, anything growth-like in that bucket. And it really isn't so much that we wanted to add risk, it's that we think fixed income, the alternative, is actually more risky and less attractive. So we went from 25%, say 30 years ago, to 20, all the way down to 15. And for the average investor with their 401k, I think it's something people need to look at. You always hear about the 60-40 as a standard portfolio. To us, it's really always been 70-30. And even if you're 50, you're going to have a 30 to a 40-year life ahead of you. You've got to keep investing in growth-like investments to stay ahead of inflation.
There's been such a growth in alternatives for retail investors. How important are alternatives to you, generally speaking? Has the market got ahead of itself a little bit? In other words, some people are looking at alternatives and perhaps not being as sophisticated in knowing what they're investing in.
Well, I would say that's unfortunately been a fault of the financial markets and people for generations, of getting over the tip of their skis and getting too far ahead of themselves. Alternative investments play an important role for us because they're generally long-term investments. So as a long-term investor, we can take the time to be patient and wait for our return. The average retail investment, I feel for them, because if your money's in a 401k, it's mark to market every single day. Most of your options are daily options, yet you're investing that money for 30 years. One day in 30 years isn't a good match. But you think about things like real estate, private equity, infrastructure, really long-term investments. They suit our portfolio very well. And I'm hoping they're going to come into more of the 401k market and for individual investors. That said, you're still going to see deals that are too high in fees, not put together well, and I wish there'd be a way to protect people from making bad decisions. All I can ever emphasize to people is do your due diligence. If it's too good to be true, it is. So don't invest in it. Understand what drives the returns. And then it's not as much fun, but you've got to peel back that prospectus and look at the cost. If you had a very aggressive portfolio over the last 20 years, but you paid an extra 1% in fees, you wouldn't have done as well as a very conservative portfolio. So fees matter. What
won't you invest in right now?
For us, we're not that heavily invested in the frontier markets. There's a lot at this global conference about sub-Saharan Africa. We're doing some infrastructure investments, but we're not ready for equity investments in that area. In us, we have a very strong focus on E, S, and G, which might be buzzwords to people, but it's environmental, social, and governance. So our fund, we don't invest in cigarettes. We haven't been in tobacco for over a decade, well actually 15 years now. We don't invest in firearms that are legal in California. The state has a law that says we have to divest of companies that might do business in Sudan or do business in Iran. Obviously that may change with geopolitics, but that has an impact on our exposure to some oil companies. So we have restrictions in the portfolio, but what we try to really do when you say what don't we invest in is look at it from a risk basis. There are some risks you're willing to accept, but a lot of risks you want to mitigate or minimize and accept a little bit, but hedge yourself out of them.
Christopher Ailman, great to talk to you again. Thank you.
Thank you.